The S&P 500 has recently been making a lot of all-time highs and is sparking comparisons to the late 1990s dot-com bubble. It's raising a key question for investors, which is, are today's market valuation in a bubble? Is it similar to the dot-com bubble? And Wall Street Journal recently ran a headline called U.S. stocks are now pricier than they were in the dot-com era. But are current S&P valuations truly more extreme than those than what we've seen in the 2000 peak? By several key measures, the answer is yes. This chart shows you the price to sales ratio of S&P 500 is currently at 3.22x, the highest level ever recorded. In other words, investors are paying $3.22 for every $1 of company revenue on average, significantly higher than the 2000 peak of 3.04x. The S&P 500 price to book ratio has risen to 5.3x, which is above the March 2000 peak of 5.1x. This means that stocks are now trading at more than 5 times their accounting book value, where book value equals to a company's total asset minus total liabilities. So such a elevated price to book level highlights how exuberant the markets are pricing the equities relative to their underlying net asset. This chart shows you the forward price to earnings ratio, and on this measure the valuation look less extreme because the red line represents the S&P 500 is currently at 22 times forward PE, and it's below the dot-com bubble era peak about 26 times. Today's level is comparable to the early pandemic rally where the forward PE was also around 22 times, and it's currently notably higher than just before the global financial crisis where we had a PE of around 15 times. That said, the Magnificent Seven, showing the purple line, carry a much higher forward PE compared to the broader index, because if you look at the purple line, it's at around 30 times the PE, the forward PE. However, we can't compare it to the dot-com era because there was no Magnificent Seven, because many of these companies didn't exist back then. Over the past decade, expanding PE ratio have indeed supported strong stock market returns. The data shows that buy and hold strategy in the S&P 500 delivered a total gain of 260% and an annualized gain of 13.7%. Which means if you buy S&P 500 10 years ago, you hold it for 10 years, you have an annualized gain of 13.7%. However, if you bought it 10 years ago, but if you sold it at the bottom of the March 23rd, 2020, which is the bottom of the dip or the mini recession during the pandemic, you sold at the bottom, you would have an annualized gain of only 1.6% and a total gain of only 17% for the entire 10 years, right? But if you also consider the inflation and stuff, you're definitely losing money. So this highlights a critical lesson we can learn from the pandemic, which is don't panic or overreact when the market is fearful, because staying invested for a long time historically rewards people. The market rewards patience. The forward PEG ratio can be seen over here, right? So this metric divides the forward PE, which we just showed you, by the 5-year forward consensus annual earnings growth rate. So the smaller the PEG ratio, the cheaper the company is, just the same as a PE ratio. So right now the PEG is at 1.45, and the ratio suggests the valuation are relatively reasonable. It doesn't look overly stretched. It's close to the pre-pandemic level over here. So this ratio indicates the markets are pricing in a bright future for the next 5 years for the companies, because when we consider them in the data, in the calculation, the ratio looks fairly reasonable. So how extreme is the concentration of the S&P 500 right now? The S&P 500 now is more top-heavy than at any point of the modern history. even surpassing the dot-com bubble. Because today, the top 10 holdings of S&P 500 account for almost 40% of the total index, right? Currently at 38.1%. But in comparison, if you look at 2000, the peak, we had the top 10 company account for 25.5% of the index, right? So this unprecedented concentration underscore how much current market performance is influenced by just a handful of mega cap stocks. The top 3 holdings of S&P 500 right now are Apple, Microsoft, and Nvidia, and they account for currently 21.3% of the total index of the S&P 500. But in around 2000, the largest 3 companies were General Motors, Microsoft, and Cisco, and they account for only 12% of the total index. And this chart shows you the ratio between S&P 500 tech sector versus S&P 500. Right now, the tech sector account for almost half of the index, right, at 48.9%. It's surpassing the peak happened in the March of 2000. So this underscores how dominated today's market is by the technology sector relative to other sectors. The high concentration have implications, right? This means that the massive gain of the index is driven by a few tech stocks and boosting the overall performance. However, it also means S&P 500 is far less diversified than the name suggests, right? If the one sector is half of it, even though you have 500 companies, it's very undiversified. And if trouble hits the sector, the tech sector, or the dominant companies, it would cause the entire index to have significant turbulence. So now to answer the question, is today's S&P 500 just a dot-com bubble version 2.0? Well, it's the similarity between the two is that markets are driven by enthusiasm for technology. And back then it was the internet companies, but right now it's the AI and the cloud computing companies. However, the differences are the fundamentals are a lot stronger today. Unlike many dot-com bubble companies with no profits, today's giants like Apple, Microsoft, Google, Nvidia not only have profits, they generate massive profit, massive earnings, and massive cash flow. And this is reflected in their profit margin as well. In April of 2000, we had the S&P 500 profit margin at 7.4%. And at the bottom of the dot-com bubble, we have it shrink to 3.4%. However, by contrast, as of July of 2025, S&P 500 profit margin is around 11%. And according to LSEG data, for the year 2025, S&P 500 profit margin is projected to be about 12.3% for the year. And it's close to all-time high because actually the all-time high was made just after the pandemic quantitative easing. Okay, so it's a very high margin to be expected to happen in 2025. And this reinforces the view that unlike the dot-com bubble era, today's stock market are supported by robust profitability rather than speculative hopes. So in conclusion, even though in a lot of metrics, today's S&P 500 is pricier than the dot-com bubble S&P 500, the key difference is that today's market leaders, Apple, Microsoft, Nvidia, and others, are highly profitable with a high margin, with a margin near record high and a strong cash flow, unlike the unprofitable tech firms in 2000. And that means even though the risks are elevated, especially around concentration risks, but this isn't a carbon copy of dot-com bubble. We can't call this one dot-com 2.0. And investors should balance caution with the recognition that today's fundamentals are far stronger than a dot-com bubble. Thank you very much. Please like and subscribe.